from middle of the summer, roughly the beginning of July through late November, the high yield space of the market was significantly outperforming the S&P 500 and big tech stocks and some other sectors as well. And the big driver behind this was simply the fact that there was a growing consensus that the Federal Reserve was going to be cutting interest rates at a fairly aggressive clip in the coming years, and that long-term interest rates would also head lower as the Fed got close to achieving its target inflation rate. However, from late November through today, here in mid-January, high-yield stocks, at least many of them, have pulled back quite sharply, with sectors like REITs and utilities and others significantly underperforming the market and pulling back quite meaningfully from their highs in mid to late November. In today's video, I'm going to discuss why this was and what the outlook for the sector is moving forward, as well as how I'm personally positioning my high-yielding portfolio to maximize risk-adjusted returns in the current environment. Before I get into the full contents of the video, if you could please subscribe to my channel, it would greatly help me increase the distribution of my videos and make it more worthwhile for me to make these videos, and also ensure that you get my weekly updates on my top dividend stocks at the moment, as well as my outlook on the broader dividend sector, as well as my opinions on various dividend ETFs and CEFs. Thank you very much. Okay, so why has the dividend sector pulled back so much? Well, again, it's because of the inversion of that market sentiment. Whereas the market was counting on fairly aggressive pace of rate cuts, a quick move back to where the Fed's target inflation rate was, and they were also increasingly concerned about the potential for a recession, which would also likely yield to more aggressive Fed rate cuts and a quicker fall in inflation, as well as more emphasis on defensively positioned sectors like regulated utilities, which generate bond-like cash flows, triple net lease REITs like Realty Income, which is very defensively positioned. But now with the election of Donald Trump in early November, a couple of pretty strong economic and inflation readings that imply that inflation was not going down anytime soon, and concerns about recession were going down, along with the election of Donald Trump, which increased the expectation that the economy would remain on solid footing due to his pro-growth policies of like slashing regulations, slashing taxes on corporations and potentially individuals as well, while at the same time he would be potentially pursuing a greater tariff agenda, which could be inflationary, at least in the short term, as the economy transitions its form of taxes from corporations to imports. And obviously the arguments over the long-term implications of that for the economy and inflation are highly debatable and beyond the scope of this video. And I don't want to get political about whose policies are better than whose, but in the near term, it's pretty consensus idea that at least in the very near term, it could be potentially inflationary. And so as a result, with all these factors in consideration, Chairman Powell and the Fed and some of their recent statements have come out and said, we're reducing our dot plot progression. So that means that they're expecting to cut rates at a slower pace than they previously were, and that they're going to be more guided by the data in terms of inflation and the economy in making their decisions about future rate cuts. And so what this means is that bond proxy securities like utilities and REITs have been coming down sharply because, again, the market prices them like bonds in many ways. And so when interest rates go up, especially long-term interest rates, which they have been in response to this news, the expected dividend yield of, say, a Realty Income or a NextEra Energy or another utility or triple net lease or even some other types of REITs and infrastructure companies, it goes up and their stock price therefore goes down. So that's led to the big decline in the sector. But there are other factors to consider as well that are unique to each space. So obviously REITs are getting hit by the interest rate movements, but also there's hundreds of billions of dollars of commercial real estate debt maturing in the next several years. And with long-term interest rates moving higher again, that's going to put more pressure on the space, not only in terms of higher interest expense on the balance sheets for REITs, but also potentially put a weight on their underlying valuation of their assets, because many of this real estate debt was underwritten when interest rates were vastly lower. And so now in some of these cases, especially in office space where they've had a lot of the headwinds from work from home, et cetera, they're going to have to refinance those mortgage debt at a higher interest rate than maybe even the property's yielding on a cap rate basis. And so that may cause them just simply to hand the keys back to the lender, default on the loan. And that's going to cause potentially a flood of new supply coming to the market on top of the already oversupplied state of the market, which could push cap rates up or valuations down in the sector, and thereby provide another headwind to commercial real estate. Time will tell. 2024 was a year with big maturities. Nothing apocalyptic happened, though there were some noticeable headwinds on numerous real estate sectors, but time will tell there. Meanwhile, in utilities, again, you have the interest rate headwind, but you also have the regulatory potential for headwind. Like, for example, Edison is experiencing in California. They're shouldering some of the blame for the wildfires there. You have other regulatory agencies that potentially are being less friendly to utilities and saying, hey, look, we're not going to pass through your request for higher return on equity to compensate for higher interest rates, to higher costs, because we want to protect the consumer's purchasing power in a period of higher inflation. And so that's been an issue in some of these jurisdictions, especially ones that are less favorable to businesses. Of course, the Hawaii situation from not too long ago, utilities on Hawaii got hit, similar to what's happened to Edison in California. And so there's actually a lot of risk there too, simply beyond even the interest rate headwind. And of course, renewable yield codes and also some utilities that are engaged in building out a bunch of renewable power production are potentially facing headwinds. For example, the Trump tariffs could potentially raise the cost of imported solar panels because the U.S. imports a lot of its solar panels from countries like China, as well as Trump has recently made some pretty harsh statements against the wind industry at a minimum. The offshore wind industry is going to take a hit in the U.S., but even onshore, the land-based wind farms could take a hit based on some recent comments he made. It's unclear exactly what's going to happen there. That's another problem to consider. Of course, the oil space, while they should get friendlier regulations from Trump, of course, that could also be a problem because if he really tries to follow through on his campaign promise of drill, baby, drill, and more oil production, it could cause the price of oil to come down, which could in turn hurt some oil companies on top of that. And mining companies, there's some blue chip dividend paying mining companies like Newmont Corporation, Barrick Gold, Agnico Eagle Mines, etc. Now, they're also facing some headwinds from increased labor costs that are helping to, or that are causing their profit margins to not be as strong as were previously predicted from the rise in the price of gold. And so that's another headwind facing them. So what does this mean? Where does this leave us for the sector? Well, here's how I'm approaching it. But before I get into that, if you could please like this video, greatly help its distribution and make these videos more worthwhile for me. Thank you so much. Okay, so how am I playing the high yield space right now? Well, again, I'm not abandoning it. In fact, I'm buying the dip. I do think that the market is seldom stupid, but often it overreacts to developments. It may get too bullish when times are good for a sector and get too bearish when times are when times are not so good for a sector. And so I do think there are a lot of opportunities in commercial real estate. You can buy an investment grade rated company with high quality assets that are relatively immune to some of these on the ground fundamental headwinds. Like, for example, I think Realty Income has been beaten down as a buy here with its dividend yield well north of 6%, trading at a discount to the underlying net asset value of its portfolio, et cetera. So again, I'm buying some real estate. I'm not fleeing the sector. I'm buying renewable power companies. I'm buying some utilities. I'm not fleeing the sector. I'm buying gold miners quite aggressively. I'm not fleeing the sector. And so I do think this dip is a buying opportunity. But at the same time, I also want to weight my portfolio towards the best all-around risk-adjusted opportunities. And so if I can find value and quality in sectors of the high-yield space, subsectors of the high-yield sector that are not facing some of these headwinds right now, or at least best positioned to weather them, that's where I want to put the most of my money. And so, for example, I think that the midstream space is a great space to be because they will benefit from increased oil production and reduced regulations by the Trump administration, which were harmful to them under the Biden administration, but they're much less commodity price sensitive, so they weren't going to get hit by potential glut of supply. They also have very strong balance sheets, very limited exposure to capital markets, so rising interest rates don't hurt them that much. A lot of them have inflation-linked escalators on a lot of their contracts, which makes them fairly inflation resistant if inflation remains higher for longer. And so you put all those things together, and I think midstream is a great place to be. And there still are some compelling values in the sector right now. And so, for example, I've said this many times, Enterprise Products Partners, it's gone up quite a bit recently, but I like it. I like MPLX. I like Western Midstream. There are several other opportunities I like a lot. Of course, if you don't like the K1, just buy MLPA or AMLP. Those are ETFs that have a diversified basket of midstream. That's actually a great way to play the sector right now. You don't have to deal with the K1. I also really like diversified infrastructure companies right now that are set up to weather a higher for longer environment in terms of interest rates and inflation. And so two ideas I like a lot right now are both Brookfield subsidiaries. I've mentioned them on here before, but Brookfield Infrastructure and Brookfield Renewable. Brookfield Infrastructure, you can buy the K1 version, which is cheaper, a BIP ticker symbol, or you can buy the 1099. You pay a slight premium, but you don't have to deal with the K1. It's BIPC. Same goes for Brookfield Renewable. BEP issues the K1. BEPC is the more expensive 1099 issuer. And the reason I like these funds so much right now is they trade at attractive values. They yield between over 5% and almost 7% in BEP's case. They have very strong balance sheets, BBB plus credit ratings, And they have their business model set up so that the vast majority of their revenue is indexed to inflation. And so if inflation remains higher for longer, their organic growth is going to be higher. And that will offset any increases in interest that they may suffer from the higher interest rate environment, especially because their debt is so well laddered that they're only going to have a little bit maturing each year, especially in the near term. And so actually, higher inflation may actually be a tailwind for their per unit growth numbers. Of course, again, the higher interest rates do beat down their equity, which we've seen, but that makes it a good buying opportunity right now. And so I think between those two spaces, those are some of the most attractive places to deploy capital right now. A third place that I've actually become increasingly bullish on recently is the business development company space. I've talked about him on here too. And of course, you can't just buy any of them. Some of them are way overvalued, like Main Street Capital, great BDC, but it trades at an over 90% premium to its net asset value, which is extremely high by any historical metric for them. And then there are some that are way too risky. Like I think that PSEC is one of the most risky BDCs. They recently cut their dividend. It trades at an incredible discount to net asset value, so it could be a really deep bargain buy, but it's just a higher risk BDC. I think the happy medium is in the middle there, where you get a good quality BDC, but at a reasonable or even attractive valuation. So something like Golub Capital BDC, which trades roughly right in line with its net asset value, has a dividend yield well above 10%, strong balance sheet, strong underwriting performance, defensively positioned portfolio, one of the lowest fees that its management charges of any external manager in the BDC space, especially given that Golub Capital is one of the best lenders, direct lenders in the world, really. If you look at, they've been very much award winners in recent years for being the best direct lender, best private lender, et cetera. So that's an opportunity I really like in the BDC space. And the reason I like BDC so much right now is because they loan to middle market companies, but they're usually almost always senior secured, especially GBDC. The vast majority of its portfolio is first lien loans. So they have that underlying asset or business securing the loan to help reduce some of the downside risk. But their loans are indexed to short-term interest rates. And so if the Fed doesn't cut rates fast, it's going to help them. It makes them less sensitive to inflation, because if inflation is high, interest rates will be high, and that benefits these BDCs, where if inflation is low, interest rates fall, which again kind of hurt their net investment income margins. So you have that as like a nice balance against, say, a REIT like Realty Income that I'm also buying. Well, not buying Realty Income, but I'm buying other triple net lease REITs like Realty Income that can help balance each other out, because if interest rates end up falling and inflation ends up falling faster than I previously expected, those ones will go up. But if it remains higher than expected, then the BDCs will do better. And so they balance each other out, along with the core holdings and midstream and other infrastructure companies that are positioned to thrive and do just fine in all environments. So again, that's how I'm looking at my portfolio right now, and that's how I'm looking at the dividend space. Hope this video added value to you. If it did, please subscribe to the channel. Please like the video. Let me know in the comments below what questions you have. Thank you very much. See you next time.